Friends, I, Captain Vivek Jain, welcome you all to my 13th episode. In my earlier episodes, I have explained some important and popular investment valuation and profitability ratios, such as EPS, earning per share, P ratio, which is price earning ratio, book value, price to book value, dividend yield, gross profit and net profit margin, ROA, which is return on assets, ROE, which is return on equity, ROCE, which is return on capital employed, debt equity ratio, and interest coverage. Friends, as I suggested earlier too, please study these ratios which we have discussed, understand them clearly, familiarize by comparing between different companies from the actual data which is available in various websites. And believe me, that will immensely assist you in evaluating any company in which business you are interested in probably, and that will enable you to invest with conviction. Friends, finally, we shall understand few more ratios popularly known as liquidity ratios. Friends, I start my presentation. The first one is known as the current ratio. The current ratio is a popular financial ratio which is used to test a company's liquidity by deriving the proportion of current assets available to current liabilities. The concept behind this ratio is to ascertain whether a company's short-term assets, which can be also called as encashable assets, which are actually termed as current assets. And these normally encompass cash, cash equivalents, marketable securities, receivables from sundry debtors, and inventory of the goods which the company may have produced for selling in the market. So this short-term assets, the encashable assets, are readily available, encashable, to pay off its short-term immediate liabilities. And the short-term liabilities comprises of short-term loans, payables to sundry creditors, accrued expenses, and taxes. It is obvious that higher the current ratio, the better it is as far as the company's financial strength is concerned. The equation goes current ratio is equal to current assets divided by current liabilities. It's as simple as that. The example is given here. If the current assets of a company is totaling 12,000 crores and the current liabilities are 7,000 crores, then this current ratio would be 12,000 crores divided by 7,000 crores, which works out to 1.71. For your guidance and information, good financial analysts, they expect minimum to range between 1.50 to 1.75. Some very, very good companies have even higher current ratios. Second one is quick ratio. As the name conveys to us, the quick ratio, also called quick assets ratio or the acid test ratio. It is a liquidity indicator that further refines the current ratio by measuring the amount of the most liquid current assets there are to cover the current liabilities. The quick ratio is more conservative than the current ratio because the quick ratio excludes items such as inventory and other current assets from the current ratio, which may not be that easily encashable. Inventory is the goods which have been produced by the company for selling, and it is just for the sake of this calculation of quick ratio, it is assumed that maybe the goods are not being sold in the market. There may be other current assets which may not be so easily encashable. So those things are excluded, and that is how quick ratio is extracted. A higher quick ratio means a more liquid current position. Equation given here is quick ratio is equal to cash plus equivalents, which are easily encashable, of course, short-term investments which can be encashed, plus receivables from good sundry debtors. All these totaled divided by the current liabilities. So in the same example, the 12,000 crores of current ratio has been reduced and it has become now 10,500 crores, whereas the current liabilities remain the same, 7,000 crores. And the quick ratio works out to 1.50. Good financial analysts expect a minimum of quick ratio of a company to range between 1.25 to 1.50. Now, very good companies have high ratios. Next one, friends, is known as dividend payout ratio. This ratio definitely should interest all the shareholders. It identifies the percentage of earnings of net income, that is, after paying off all the expenses and taxes and everything, per equity share, earning per equity share allocated to paying cash dividends to shareholders. If a company is earning an X amount of rupees for every share as net profit, which is known as earning per share EPS, definitely the company will not pay out the whole amount as dividend, because the company has to grow, the company has to plow back some money, the company has to build some reserves for various other expenses. So a part of the net profit is given out and the remaining portion is kept and for plowback and for reserves. The amount that is given to the shareholders is called dividend paid out. Now, how much is dividend payout ratio? It has to be some percentage of the whole net profit. But that is what we have to understand. During any fiscal year, a company's board of directors, they declare a dividend. Out of the total net earnings of the company, like I said earlier, a portion is distributed to the shareholders in proportion to their individual shareholdings. And the remaining portion is retained, plowed back into the company, and also can be included in the shareholders' equity reserves funds for future use. The shareholders' reserves fund is usually utilized for meeting the outstanding liabilities, purchase of new machinery and equipment, enabling growth of the business, or any other expense which will improve the profitability of the company. The equation of the dividend payout ratio is simple. It is dividend which has been allocated and is distributed to the shareholder per share divided by earning per share multiplied by 100. As an example, if a company earns 20 rupees earning per share and the company decides to pay 5 rupees as the dividend, then 5 rupees divided by 20 rupees into 100 works out to 25%. That means company has paid out 25% of its earnings as dividend to the shareholders and 75% has been retained in the company. As per analysts' expectation, on an average estimate of most of the good growing companies, dividend payout ratio should be between 25 to 33%, so that the remaining 75 to 67% can be plowed back. Any company with a dividend payout ratio of less than 25% is termed as being conservative and unfriendly towards shareholders. This is a normal expectation and a normal benchmark of a figure it is not to be firmly adhered to. However, it does give an indication of the policy of the management. The management policy has to be read out also as to why the dividend payout ratio is way below or way high. So these things will be considered on case-to-case basis. Like is written over here also, unless as an exception, in some low payout years, good reasons are tendered. It can be many of the reasons. Some of them like preserving funds for purchase of machinery and equipment, to avoid taking loan for same. And this is especially valid for growing and relatively new companies. An older company or a company which has built a good amount of reserves may delve into its own reserves for such expenses and maintain a reasonable payout ratio. However, a new company may initially pay out low, build reserves, and as number of years are passed by, they may keep increasing their dividend payout ratio to reasonable levels. High payout ratio. Any company with a high dividend payout ratio may not be to the liking of shareholders. Why? Because it may depict lack of growth plan of the business. The company probably is not thinking of any further growth, maybe. Or maybe the company has got too much of cash and it is not able to spend that cash for the growth of the business or development of the business. Or it can be so many other reasons. Again, like I said, we have to take that on a case-to-case basis. By and large, a high payout ratio is not really liked by most of the shareholders. Now, friends, having learned some ratios, we should be able to assess the quality of a company, enabling us to decide if the business is of interest to us and should we go ahead and buy its equity shares from the stock market. This fundamental analysis of any company will become more and more interesting with practice. With constant and continual study of balance sheet, profit and loss account, various financial ratios, and last but not least, your own interest. Because I would like to remind you yet again that investing in equity shares requires your hard-earned money, your money at stake, your money in a particular business or businesses. Avoid going for tips, hearsay, advice from here and there, because I firmly believe and say with experience that it is only you who shall be the best judge. In our next episodes, we shall take few practical examples of actual financial statements of few companies and then discuss them for our knowledge and understanding. Friends, if you have found this discussion knowledgeable, please do subscribe to this channel in case you have not done so far as yet. This will ensure that all future episodes and past ones are appearing on your screen in good time. Do put in your valued comments in the space provided. With queries, if any, I shall try and reply to all of them. See you again soon, friends. Have a nice day.